Good morning, everybody. Kirk Spano, Investing 2020s on Saturday, November 11th. And we are going to talk about Aemetis today because that is our top microcap holding. And I just want for the new people to give the framework of how we think about things again so that when we are evaluating and investing in micro caps and small caps and even mid caps, and I guess even large caps, but really the smaller you get on the capitalization scale, this matters, is that we want to avoid questions like, why did that happen? Why did it go up today? Why did it go down today? Why didn't it go up today? Why didn't it go down today? Those are the types of questions that lead to emotional back and forth with your trading that probably should not be occurring. And I want people to understand that the things that you've heard from Warren Buffett and Peter Lynch, Royce Investments, you go right down the list, Graham, all the famous investors who try to tell you, look, it's not about the price action in the short term. The price action in the short term is something that you can use to your advantage if you let it come to you on the price. Now, if you're a superstar trader like Shooter and you can get ahead of it because you're putting in dozens of hours a week into technical analysis, then fine, go ahead and be a trader. However, if you are the 3, 4, 5 hour a week person who is reading up on your companies, setting some limit orders, and then coming back in a few days to check, if you don't control your emotions, if you don't actually learn about your companies, if you get to the point where you're asking questions like, why did it go up? Why did it go down? Why didn't it? Why didn't it? You're just going to have a crummy investment experience. To make things better, you need a framework. And we have a framework. It's a simple 4-step method to investing that works, that has made a lot of people before me and will make a lot of people after me multimillionaires. Very simple, 4 steps that I want you to think through so that you can build a framework to work within. I was calling it the Core 4 investing method. This report needs a refresh because somebody else uses that name already and they have it copyrighted and everything. Ooh. But confronted with the challenge to distill the secret of sound investment into 3 words, we venture the motto margin of safety. From the book, The Intelligent Investor by Benjamin Graham, who is Warren Buffett's mentor. And if you have not read The Intelligent Investor, shame on you. Buy it on Black Friday. I'll give you a link and everything, and probably by tomorrow, and buy this book and read it because it is the type of foundational knowledge that you need. Our investment approach derived from the great investors and some big institutional investors that I got to know back in the 1990s, a whole different century when I was starting out, goes like this. First, invest with the secular trends. Understand what the gigantic secular trends are and stick to investing in them. Nothing else really means much of anything else. Everywhere else is where you find the zombies. You don't want to invest in zombies, not the industries, not the companies. So the big secular trends today are what? Well, the biggest secular trend has probably been technology for decades. And right now it's going by the name Fourth Industrial Revolution technology. And everybody's darling is the artificial intelligence within that revolution. But the Fourth Industrial Revolution is a lot of things, from low latency communications, 5G morphing into 6G and satellite communications, space, 3D manufacturing, biotechnology, a whole host of things that are taking production to whole different levels. And it's a curve, it's not a straight line. And over the next 10 years, which is the time frame that you should be considering as your backdrop, not necessarily your investment horizon, but the backdrop that you will invest within, we are going to see a curve in productivity that is rather amazing because not only the processes, the hard processes of manufacturing are going to keep getting better with machine learning, but the technology will continue to advance because of our study of space and the rest of the world. Changes in biotechnology are making us healthier, living longer. I still have one of my 94-year-old grandmothers kicking. I'll see her at Thanksgiving. The other one, just passed less than a year ago. And they were World War II kids. And they made it into their 90s. Imagine how long we're going to live. And that leads me to the next big secular trend, which is aging demographics. As the planet gets older, we live longer in retirement, even though we work longer. But because of that fourth industrial revolution, we shouldn't have to work as hard because our generative AI assistants are going to do a lot of the busy work for us, right? The stuff that made us hate our jobs. And finally, you have the decarbonization of the global economy, probably in the second or third inning, just ready to get to the exciting part of the game, moving at breakneck speeds. One of the headlines that I didn't end up putting up for us was that oil inventories went up dramatically, which is why prices went down lately. And this is in the face of the risk of an escalating Middle Eastern war. The idea that the clean energy revolution or the decarbonization movement is not massive by trolls on the internet is silly, duplicitous, dishonest, manipulative, and ideologically stupid. So between technology, fourth industrial revolution, aging demographics, and the decarbonization of the economy, you can pretty much find everything that you need to invest in. That's a pretty broad umbrella. It excludes investing in things like, breakfast cereal. A lot of the consumer staples that are out there are commoditized industries that have lost virtually all of their brand power, substitution with generics, and local brands, utilities, except where they're supported by government, and have an edge in clean energy, for the most part, junk investments. There's a handful of winners in there, and we know what they are. Real estate is bifurcated. We have a shortage of residential, a shortage of industrial, and an overwhelming inventory of commercial, which we'll talk about in a minute. So when we take a look at the secular trends and we take a look at government and central bank policy, and then ultimately the fundamental value of different industries, and then top it off with technical analysis, taking a look at the price trends, what we find is if we follow this 4-step process that you are looking at, we can win. We can pick out really good stocks, and we'll be wrong here and there, usually because executives are giving us a line of shit. And we're like, oh, my bullshit detector missed that one. It's going to happen. I have an excellent bullshit detector, and yet I miss things too. And that is why technical analysis actually becomes important, is because in the face of an analysis that we can make that we think is right, when price moves against us for too long, we have to reevaluate. Sometimes that reevaluation will be that we were wrong. Usually we're right, and the market is wrong. And in those cases, all you really have to do is wait out the market. Let it exhaust itself in one particular direction or the other, and then you make your purchase or your sale. So in the case of declining stocks, you let the market exhaust itself to the downside, meaning that between shorts manipulating the market downward and retail investors panic selling and sometimes institutional investors selling, there ends up being a price that a stock can get down to that's just so low that there's nowhere else for it to go but up, unless it's going to zero. And in most cases, they're not going to zero. Stock we'll talk about in a few minutes, we had one of those opportunities. And a lot of those opportunities are out there right now, especially in the micro cap and small cap segments, but also some in the mid cap and a handful in the large cap segments. And I'll tell you why. Let's understand this big picture. We are in what I have been calling since 2016 the slow growth forever global economy. And that is the idea that demand growth for goods and services is slowing. It doesn't mean that there is recessionary pressure with no growth. It just means that the growth rates have all slowed down. This has been true since 2007. There are wiggles when the curve goes up, but when you take a look at a longer term view of the chart, it's very easy to see that aggregate demand for goods and services has fallen in its growth rate. So rather than growing at 4 or 5% a year, it's growing at 3 or 4% a year. And those changes make a huge difference when it comes to things like corporate profitability, the ability for valuations to stretch higher. Last week, we talked about a report, a working paper at the Federal Reserve, which discussed that the age of rapidly increasing corporate profits is probably over. He based his conclusion on the fact that tax policy and falling interest rates accounted for most of the expansion in valuations and earnings of stocks. So not only did earnings go up fast from the late 80s to 2019, that's where his data ends, but I think it would apply through 2021, and his update to that working paper probably will reflect that at some point. But from the late 80s to around 2021, corporate earnings expanded at a very fast rate compared to the prior period, even though we think of the 50s and 60s as a golden age in the stock market, rebuilding after World War II. And we replicated that type of growth and actually beat it from the late 80s to about 2021, with the peak coming just before the financial crisis, when we leveraged up so far in our hubris that we blew the whole damn thing up. But now, because of aging demographics primarily, but also because technology is disinflationary, which is different than deflationary. Deflationary means things are going down. Disinflationary means that they are going up at a slower rate. We are continuing to face deflationary pressure on the economy from aging demographics and disinflationary pressure from the technology. We had a supply chain disruption that was severe because of COVID. And when that was combined with the massive monetary and financial response by governments and central banks, we saw inflation for about a 2-year period. And as I talked about 2 years ago, inflation would indeed be transitory. It's just that the price levels would all be higher. We're not going to come off those price levels that we've gotten to, but those price levels will now increase much slower. And in fact, inflation is pretty much licked. The Federal Reserve, in slowing down the economy a little bit, is actually forcing some shifts in real estate that will be consequential to the residential supply shortage. And that'll hold things like housing prices down for a long time. And I'm not saying that housing prices won't go up. They'll just go up at a slower pace. Disinflation. One of the things that will offset what is going on in the slowdown economy, this is an article from Foreign Affairs. I've told you if you can afford this, $48 a year or whatever it is, you should read it. One of the best publications on the planet. Michael Spence was just on Bloomberg Week this morning, and he gave a good interview where he talked about the Great Slowdown. And the way he discussed it was essentially what I said here 7 years ago. And I had actually been writing articles on Market Watch since 2013 about this concept. I just gave it the nifty name Slow Growth Forever 2016, which I'm going to revive in a series of articles coming up because, hey, why let a good thing die? In any case, the Great Slowdown is not something I came up with. It's just something I recognized, and a lot of really smart people get it. The reason I pound on this point is because a lot of you have a hard time believing it. You have a hard time believing that's the paradigm that you live in and will live in forever. But it is. That doesn't mean there won't be fits of growth, usually after a downturn, COVID, to big rally afterwards. But on a smooth scale over a long period of time, the growth rates going forward forever will be lower than what the growth rates were during the post-World War II era and during the era from the late 80s to about 2021, when we had falling interest rates for an extended period of time and falling corporate tax rates for an extended period of time. We are now in an era where interest rates have normalized, something that I'm calling the Great Normalization because that one hasn't been appropriated too much. The article that you'll see from me at some point when I finish it is The Great Normalization by Jerome Powell, or according to Jerome Powell. Not sure how I'll title it. And in that scenario, the long end of the curve, your 30-year bonds, will have an interest rate around 5%. Your 10-year bond will be around 4%. 5-year, around 3%. Then everything under that, somewhere in the twos. That's going to be your normal curve, plus or minus a point. We're not going to see 7 or 8 or 9 or 10% 30-year yields because there's not a government or central bank on the planet that can afford that. They have discovered the genie of quantitative easing, and that genie will be there forever when they need it. Most countries in the world do not have the incredibly strong economy that the United States has and the ridiculous gift of the perfect geography compared to really everybody else. We have the best rock on the planet. And that is a massive advantage that gets understated over and over and over again, and it's hard to quantify. I didn't fully understand it until in the early 2000s, I started driving around the country with my kids. Starting in 2003, I think it's the first time I took them out of state, maybe in 2002, just started driving around the country. And as I made these trips across the country, as my car broke down in Beaver Falls, Pennsylvania, Joe Namath's hometown, and I saw what looked like a bombed out Main Street, all sorts of boarded up windows, right after the financial crisis. And I drove back every few years after my trips out east, take the extra few hours to go that particular route, and drove through the rest of Pennsylvania and Indiana. Doesn't matter, pick a state. As you drove around the country, I started to see, or you would start to see, that the potential for the U.S. economy is so high because we have so many resources, but we break so many things and we ignore so many things that we're in such a better position than almost anybody else on the planet except a few small countries. And you realize, man, we got it good in the United States. We're just really stupid about how we manage it. And that plays into the policy part in our 4-step process. But the backdrop remains the same. Slow growth forever is a thing. Now, that paper from the Federal Reserve that we've talked about in other weeks, which talks about how corporate profits are going to be growing slower because interest rates really aren't going to be zero again or close to zero again. And because corporate tax rates are going to be a little bit higher, I think actually overstates things. I don't think it takes into account for this. The fourth industrial revolution, AI in particular, is going to offset the need that we had for super low interest rates and for letting gigantic corporations not pay any taxes, right? It never made sense why those giant corporations who said we have, $1 zillion in earnings didn't pay corporate income tax. There is a great rebalancing, right? We like to use the word great, that is happening. And these secular trends are the backdrop for everything. Now, where are we today? Well, we are in the midst of a slow motion commercial real estate crisis. There is over $1 trillion in commercial real estate debt that is potentially troubled. Over half of that is held by the regional banks and credit unions. That is where there's going to be some problems. Credit Union Times talks about it. They're seeing delinquency rates up to 5%, at 5.1% and rising. That's a really high delinquency rate for commercial loans. So let's suppose that entire 5% is representative of who's going to go bust and give the keys back to the banks. That means that this debt here that's troubled, which is represented by that 5% probably that's not paying their mortgage payment, we're looking at over $1 trillion that's going to be needed to be infused into the banks so that depositors and creditors are made whole. What have we been talking about for months now? U.S. Treasury market. And all those table pounders and chest thumpers and foot stompers and screamers and yellers and capital letter tweeters and bloggers. The dollar's going to hell because the U.S. Treasury market is going to hell because nobody wants our debt. Well, that's not true. It's still a $25 trillion market that's mostly fulfilled. At the margin, you have China selling off a little bit of our debt. How can you replace that? Well, the hedge funds have been the ones filling the gap for a while now, but they use a lot of leverage. The banks took a step back because as interest rates rose and their balance sheets got worse because of it, they couldn't buy as many treasuries. Now that interest rates have roughly peaked and we have this commercial debt problem hitting next year, and it's been hitting this year, and it's going to hit in 25 as well, the Federal Reserve has an answer for that. Here is quantitative tightening, right? If you take a look at it, we had all this COVID money, and now they're dialing it back. We're probably not going to get any further than around here. This money is in the system forever, but this line probably gets down in here around $7 trillion. They got about $1 trillion to go. Let's take a look at the last year. What the heck is that? What is that? Why'd it go up? They didn't announce any quantitative easing. Well, when SVB, Sovereign, and First Republic went under, they put money into the system to make sure that the depositors were okay. They did that in conjunction with the FDIC, and they absorbed a lot of the risk so that JP Morgan could go out and buy First Republic, so that Citizens Bank could go out and buy SVB, and I forget what happened to Sovereign. And then they resumed quantitative tightening. You're going to see another one of these next year. It's going to be bigger than this, though. It's probably going to be about $1 trillion. I'm going to give you the sound of what it takes to create $1 trillion. There you go, $1 trillion. That's all it takes. And you'll get this pop up. That $1 trillion will bail out the banks that need to be bailed out. It will be conditional. They will have to merge and become bigger banks, which means that they get back into the U.S. Treasury market, because that'll be one of the other hooks. You give you cash, you need to buy treasuries, and they'll go out and buy 10-year treasuries. And then they'll turn around as they collect their 4-something%, and they'll start paying you only 1% on your money market and your checking again, but they'll give you a mortgage at 5-something% versus the 7-something% that it is today. And 5-year ARMs will become very popular again, and so will 7-year ARMs. They might even do some sort of 10-year ARM. I know those exist, but I don't think many of them get done. Why is what the Fed is going to do next year important? It's because every time they do QE, stock market jumps. And at some point, when they get to around $7 trillion on the balance sheet, quantitative tightening is done. And then we get a very normalized economy with slow growth forever. So what has been the result of quantitative tightening over the last several months? Retail investors sold off stocks at the fastest pace since 2021 in October. Notice who's investing, though. You got your indexers, right? The 401k money. And you got the hedge funds, who theoretically are the smart money. Retail has been selling. Why have the institutions been selling? Pensions. And what are they in right now? Drawdown. Why? Because millennials don't have pensions. Because during the 80s, pensions started getting canceled, stopped being given. And over the last 30 years, they've been getting bought out. So pensions still have all this money, but it's for the baby boomers. Baby boomers, essentially the last generation to have pensions. You know, a handful of Xers have them, almost no millennials. Gen Zers don't even know what the hell they are. It's probably why that we need to increase Social Security benefits at some point, which would mean taxing the rich a little bit more. Really just getting rid of the cap on Social Security taxes, or maybe creating a donut hole. Right now at about 155 or 157,000, you stop paying Social Security taxes. So does your employer. Maybe if you earn over $1 million, you start paying Social Security taxes again. I don't know. Social Security is mostly funded through the end of the century. They have a very small hole to fill, which mathematically is simple. If they want to expand it, that's a tougher call. So we'll see. Given that we already have calls for universal basic income, which is putting the cart way before the horse, because we don't even have universal health care yet, which is probably more important. We got a lot of things to do, but pensions are selling. So this is perpetual pressure on the stock market. Here's the good news. We know what they're selling. They're primarily selling large caps, S&P 500 stuff. So these indexers, right, your 401k folks, are buying SPY because they don't know any better, and Jack Bogle blindfolded them and spun them around and pointed them at SPY, and they go, oh, well, look, that's what we should invest in, or VOO. But that's what these guys are selling. So if these folks are selling SPY and these folks are buying it, does that not strike you as dumb? Right? It's dumb. That's why we never invest in SPY. Never, ever, ever. And there is no who's right and wrong here. Well, the people who are indexing are wrong because they're investing religiously rather than objectively, right? They're investing on faith, on the idea that indexes just keep going up. Well, not if there's a gigantic major seller over the next 20, 30 years, till the pension money's gone, sometime in the baby boomer lifetime. And that's why I've said, as the baby boomers start to die off in the 2040s, maybe the 2030s, right, the last ones are retired in about 2029, 2030, maybe that changes, right? The box changes, the math, the lines cross. The idea that indexers trade much is silly. They don't. The average indexer literally makes one trade every 3 years. We know that. Fidelity does those studies. Whereas institutional investors make about 5 major asset allocation shifts per year, right? One every 3 years for your indexer in their 401k, 5 asset allocation changes for your institutional investors, which is about what I do. And hedge funds are hyperactive, and traders are hyperactive. And retail is completely driven by emotions. That's why 80% of them lose on their trades, which is why I tell you, unless you are some superstar savant trader and have 5, 6, 7 hours a day to do it, you shouldn't trade in the daily market because you're up against shooter, me when I decide to do it, when I don't have something better to do. Bunch of guys from Wall Street who understand how it works, and their mouthpieces on TV who are there to make you emotional and jump up and down and think of it as entertainment. Jim Cramer, I'm looking at you. And there you go. So if these guys are buying now, right? If this and this are basically offsetting each other, and these guys are buying now, these guys are selling now, what happens next? Smart money, dumb money, right? We've looked at that chart in the past. When retail starts investing, it'll push prices up, and eventually these guys will sell to them. So all you gotta do is wait for it to come. So there's an idea about efficient and inefficient markets out there. And in the large cap space, markets are largely efficient. You can figure out the math. In the small cap space, it's more like a teeter-totter that sometimes has a boulder drop on one end. The micro cap space is probably the easiest space to invest in if you understand that the micro caps that become small caps and get included into the Russell 2000 is a bigger jump in market cap as a percentage than the jump from mid cap to large cap. So as companies under 300 million hit 300 million, they get included in the Russell 2000, and then IWM, which institutions use for their asset allocation, is forced to buy them. And the reason that institutions can sell off this much is because they have a lot of money. So when a company goes from microcap, basically not in an index of any meaning, to the Russell 2000, which is widely used, and the other copycat funds, that jump is usually from about 300 million in market cap to between 1 and 3 billion relatively quickly. And that's where you find your 3, 5, and 10 baggers more often than not. It's almost systematic. It's the reason I'm in a number of microcaps right now. They are former small caps in most cases, got pulled off of the Russell 2000 that by a function of time and executing on their businesses over that time are going to get added back. Did you ever want to redo? Well, let me try that again. We have a roadmap on how to invest in microcaps right now. And when the Fed does this and then stops this, that's going to be a lot of liquidity added to the system. And as Shooter said in the comments, every single time there's liquidity added to the system, stock market goes up. And usually the micro and small caps go up the most as a percentage. They won't get the most news. Your Magnificent Seven will get the most news, but that's the way it works. So you know who my favorite microcap is, although it's followed closely by a satellite company and a few others. A few satellite companies, actually. Aemetis, fourth industrial revolution technology they use to make biofuels and do carbon capture, which are part of the decarbonization movement. 2 major secular trends here. And this is what they do. They have dairy renewable natural gas. They use dairy digesters to capture the methane from the cows. They use USDA loans to build those digesters that are 20 years and low interest rate. And then once the digester is finished, they get a investment tax credit for having finished the build out. And then they get ongoing production tax credits for the renewable natural gas. It's great business. Right now, we just saw them get $63 million in investment tax credits. And next year, they're probably going to get almost the same, a little bit less. And then the year after that, they're going to get quite a bit more. Unless, of course, financing gets a little bit easier and they can finish the dairy digesters faster. Right now, they're a quarter or two behind because financial conditions got tighter. Once financial conditions get looser, they make a shit ton of money. Get it? A shit ton. Renewable jet and diesel fuel, SAF, is a plant they're building that's been approved, been permitted, the big scale permit, right? Your little building permits, the one where the inspector comes, they still have to get those over the time that they build the SAF plant and renewable diesel. The neat thing about the plant that they're building, the refinery that they're building, is that the system they're putting in can operate in a way that allows them to increase the SAF if they want, and or the renewable diesel. So it really is just a matter of what the market demands. What we found out from the earnings the other day is that they are looking at a potential joint venture partner on that refinery. We've known that actually for a couple of years that maybe it would come to that, but really as a way of mitigating risk, it makes a lot of sense. They already have over $3 billion of contracts for both the renewable diesel and the sustainable aviation fuel. That's a lot of contracts backing the deal, but they still need financing. I don't know who their potential joint venture would be with. Chevron makes sense at one level, but another one that makes sense is Delta. Remember, Delta Airlines owns a refinery out east. It would make sense for them to have an SAF plant basically serving San Francisco, Los Angeles, and Las Vegas, and maybe Phoenix, right? Right in that area. They'd have to figure out if they can run pipes to all those places. They already have the San Francisco airport. It's all set up or in process. The California ethanol plant, which was a legacy business, suddenly became a lot more profitable. Probably going to throw off $20 to $30 million of free cash flow next year. Not a mountain of cash, but remember, it was a break-even business because the ethanol market has always been kind of crummy, right? Up and down with too many downs. But they put in a solar microgrid. They put in a Rockwell management system. And now suddenly it's a more flexible plant and a ton more efficient because the energy costs are almost nothing. The India biodiesel is where they just got the $150 million contract for next year that soaks up 2/3 of their refinery capacity. Remember, India has mandates that far exceed current supply. So demand is going to continue to increase in India for biodiesel. And by the way, as a byproduct, they send over tallow, which is used in biofuels here. And then the carbon capture. And this is the one that I actually don't even put into my model. I don't count carbon capture in my estimate for Aemetis over the next couple of years. So I believe Aemetis gets into the 30s, right? A little over $1 billion market cap just on the RNG business and the ethanol business and the India business. You put in the SAF, now you're in that $2 to $3 billion range. The carbon capture, though, is a big deal. That is the thing that, because the tax credits are so gigantic, that if they really start doing it, the way the math works out, it's like a curve. It's just unfreaking believable. It's just piling cash on top of cash. All of a sudden, a company that probably can get to about 3 billion without the carbon capture, maybe 5 billion. We'll see how the financing in the short run affects things for the long run. 5 billion, by the way, do the math, that puts you way over $100 a share. But even at $1 billion in market cap, you're in the 30s. Add the carbon capture, and suddenly you're like, this is a potentially $20 billion company that a Chevron or California Resources or Occidental or Exxon or BP would want to buy. So it's pretty neat business. And what we learn when we take a look at the 5-year plan is that they're going to be a billion plus company probably soon after Russell inclusion, or maybe going into Russell inclusion, and maybe Russell inclusion pushes them to that $2 to $3 billion level. And then as they hit their milestones, maybe it gets to 5 billion. But if carbon capture happens, to the moon. Now, the one thing that's holding it back in the short term is the debt. Because financing got tighter, their interest costs have not come down as fast as projected. And that is the one thing that the shorts point to. It's the one thing. There's nothing else that the shorts hang their hat on. So there is a deal in place to get rid of the 102.5 million that they owe on the preferred shares. It's a little expensive. It's going to cost them somewhere in the range of $22-23 million over the course of a year or so to pay down the 102.5. So they're looking for a way to bring that down. We'll see. Now, the thing with Third Eye is they are an equity holder in the company, and they've been, as part of their renegotiations of the debt lately, been asking for more equity. At some point, Third Eye is going to want to make a lot of money on that equity, right? And if they had wanted to bury Aemetis, they could have done it years and years ago. They're a long-term investor. They understand the outlook. Yes, they're bleeding it of a little bit of extra money, like a typical banker will, but it doesn't push them out of business. It's not onerous. And as equity holders, right, they want to get paid on their equity. All of the surprises for Aemetis are lined up to the upside. All the things related to these businesses are more likely to be positive than negative. The one potential negative is if California continues to drag their heels, as bureaucrats do. So we shouldn't discount that to zero. But it sounds like in January they've got a plan. We'll see. If you live in California, write to CARB and say, hey, for Christ's sake, we got a company right here in California that wants to lower the carbon footprint for trucking and for airplanes and for dairy. Stop jamming it to them. And really, they're not jamming it to them. They're just going slow. It'd be very easy for CARB to reset the market for certain tax credits and incentives, that they go back to where they were a few years ago, which is what a lot of projections are based on. And suddenly everything's, fine and dandy again. If the prices stay where they are, that is why my range on the market cap of 3 to 5 billion, which is a pretty wide range at that level, is there. I don't know if we're going to get cheap California, meaning that Aemetis probably only gets to around 3 billion minus carbon capture, or we're going to get the California that was promised a few years ago, in which case 5 billion is more likely. Still both good numbers, given that it's 180 million market cap company right now, right? That's where you're at. Stonegate put out a report, as did H.C. Wainwright. H.C. Wainwright is more bullish than Stonegate, but Stonegate is still saying the price in that range that I talk about, as high as in the 30s or as low as in the upper teens. Upper teens represents about a $600 or $700 million company, which actually doesn't make any mathematical sense because of the Russell 2000. Once the stock is on the Russell 2000, which probably happens in May, you're probably going to see a price in the 30s. It's really that easy. One of the things that will propel that is the short interest, which is obnoxiously high because you have a bunch of junior achievers shorting the stock and touting their stuff Yahoo message board and in their own little circle. They must have a trading room somewhere. And despite an incredibly high short interest of about 14%, there you go. Their update here says 16.75%. Despite a short interest of 16.75%, according to Fintel, and it's plus or minus a point or two, nobody really knows perfectly, they can't push this stock price down below 4. They've been trying, right? They got their standard pullback from the bottom to the top, right? The price was down to about $1.50, went up to in the 8s. Typical retrace is about half of that gain. So you'd expect about $3 or $4 off the top. That's where it landed. It's been chopping along for 2 months, and they can't push it down. You have institutional investors like GMO, Jeremy Grantham, Alliance Bernstein. Susquehanna has been increasing. So I have a couple of others. Where's Susquehanna? There you go. Big jump in shares there. Vesco, right? That's driven by some microcap index. This one's interesting. This is the Dorsey Wright is adding it. Dorsey Wright's a pretty good fund. It's a quant fund. So you have institutional ownership. What normally happens with microcaps is they get close to being included in the Russell 2000. There's a whole bunch of money managers start to buy the stock in anticipation of it being included in the Russell 2000. Because all of a sudden, when the Russell 2000 has to buy IWM and the copycat funds, they have to buy, in the case of Aemetis, probably 3+ million shares. Well, that's almost 10% of the float. Actually, 10% of the outstanding. It's more of the float because about 40% of the company is in the hands of insiders and institutions already. So as that float shrinks, the shorts who are shorting 16% of the stock have to cover. They have to find the shares to cover that short, which they don't have right now. The short squeeze in May, June, July resulted in massive fails to deliver. Look at the fails to deliver here. That is the short covering. That is them not having the shares to borrow. Well, what happens as first money managers, as we're seeing now, and then the Russell 2000 have to buy? So I'm pretty sure that we see a price in the 30s next year. Can it happen by January? I don't know. I'm probably going to have to roll my calls that I have remaining. Remember, I sold about a third of them. So we might have to spend a quarter and roll those calls. It'll be worth it. All right. So that's the short story on Aemetis and the framework that it works into. If you want to read the waiver and credit agreement for extinguishing the Series A preferred that's out there. Pretty straightforward. They pay a closing fee of $5.5 million. Then they're going to pay about 16-17% in interest for a year. And all the ITC credits go towards paying this down as part of the terms and conditions. Probably is paid off in about a year and a half. But, right, it costs them $22-23 million to do that, which is, real money. So he's trying to finance this a different way that's cheaper. We'll see if somebody will step in. I got to think that there's a $100 million investor out there that'll say, hey, give me the rights to the ITC credits, or maybe 50% of the rights to the ITC credits, and I'll give you, a 12% 5-year loan. And if you can't make the interest payments, I'll take shares. That's probably the deal I would cut. That's kind of a Warren Buffett type deal. 12% until you pay me. You can pay me in shares, and I get first rights to the known tax credits. It's out there. I don't know if it'll happen. We'll see. All right, so that's that. I still expect the price of Aemetis in the 30s next year, and I don't know if it takes all the way until summer after they're on the Russell 2000. Maybe it does. If it does, I'll roll my calls. I'm not selling any shares until it's a $1 billion company, and maybe not until it's a $2 or $3 billion company. We'll see. Depends on how things are going. We'll have to keep an eye on it. Don't have preconceived notions of when you're going to sell. Know the company. Understand the business. That's how you know. Not just saying, when it goes up to this, I'm selling. Wrong way to invest. Just like asking why to go up, why to go down today is the wrong way to invest. Know the company, understand the time frames, keep an eye on what's changed, right? Financing has gotten tighter. Some timelines have gotten pushed back between 1 and 3 quarters, right? The SAF plan probably won't break ground until later next year instead of earlier. That means everything's pushed off a few quarters on the SAF, maybe a year. But they're a year ahead over in India, and those contracts are getting bigger too. Lots of moving parts with this company because they have basically 5 lines of business. But the tax credits, the same reason that Berkshire Hathaway wants Occidental for the tax credits on the decarbonization, it's the same reason you should want Aemetis, because the pass-through on the law of small numbers is massive. For a while, for several years, this could be the highest margin refiner in the world. That's how big of a deal it is. Not only do you get the federal tax credits, but California's got the richest tax credits in the country, even if they end up being a little smaller than what we had hoped for or what we were told they would be. Nobody's close. So it's tax credits on top of tax credits on top of an in-demand business. All right, so let's call it a day, and we are going to bring Shooter on here in just one moment.